The secret life of your bank deposits, how banks turn your money into their profits. Let's start with a fundamental truth. In today's world, most of our money isn't physical. It's digital, numbers on a screen. When you deposit money in a bank, it's not stacked in a vault. It transforms into something much more fluid. This digital nature of money is the first step in understanding the banking alchemy. Banks are not just safekeepers of your cash. They're businesses, and their product is money itself. When you deposit, say, $100, you're actually giving the bank the green light to use your money. And here's where it gets interesting. They use your money to make more money, not just for you, but primarily for themselves. Let's demystify fractional reserve banking, a key pillar of the banking system. Here's what it means in factual terms. Banks are required by regulation to keep only a portion of their depositors' money as reserves. This requirement, known as the reserve ratio, varies by country and bank size, but is often around 10%. So, if you deposit $100, the bank needs to hold $10 as a reserve. The remaining $90 becomes available for the bank to lend out to other customers. Yes, banks legally lend out most of the money in your bank account. You see, the moment you make a deposit, your money is changing ownership and it's now owned by the bank. And if you think what you just heard sounded crazy, from here, it gets even crazier. Banks can multiply the money in your account and make nice profits. If you want to understand how it all happens, pay close attention. Let's break this down with an example. Say you deposit $100 in Bank A. With a 10% reserve requirement, the bank has to keep $10 and lends out $90. This $90 then gets deposited into Bank B by the borrower. Bank B now follows the same rule. It keeps 10%, which is now $9, and lends out the rest, $81. This $81 finds its way to Bank C, which again keeps 10% and lends out the rest. This cycle continues with each bank holding a fraction and lending out the majority. As a result, your initial $100 deposit can create a total of $1,000 in the banking system. This multiplication effect is a cornerstone of how modern banking operates, turning a single deposit into a significant sum through a chain of lending and redepositing. Let's address a common question. Why does your bank account still indicate a balance of $100 even after the bank lends out a portion of your deposit? The answer lies in the unique mechanics of digital banking. In this system, money possesses a dual existence. It's a concept that challenges our traditional understanding of how physical objects work. When you deposit $100, the bank records this amount in your account. This digital entry signifies the bank's obligation to you. It's their promise that you have $100 available for withdrawal or use. However, when the bank lends out, say, $90 from your deposit, it doesn't physically remove this money from your account. Instead, it creates a new loan by simply adding a digital entry in the borrower's account. So now, your $100 appears to be in two places simultaneously. It's still visible in your account, and at the same time, it's recorded as a loan in someone else's account. This dual presence is possible because in digital banking, money is essentially a series of accounting entries. These entries can be replicated across accounts, allowing the same funds to be used in multiple places at once. This system enables banks to extend credit and facilitate economic activities. This, of course, requires regulation and management to ensure that banks maintain enough reserves to meet the withdrawal demands of their customers. In essence, while your account balance remains unchanged, the bank uses your money to generate loans, which means the creation of new money. You heard that right, it's new money. If your head is not spinning yet, it will be soon when I reveal how money is created from nothingness. Brace yourself for a deeper dive into the astonishing world of money creation, a process hidden in plain sight, yet rarely understood in its full complexity. Most of the money in our economy, an astounding 90 to 95%, or even more, isn't created through the minting of coins or printing of paper currency, but through digital transactions in the banking system. But here's the real shocker. This money didn't exist before. It's new money that banks create when they create a loan, a debt, and this same money vanishes when debt is paid back. So, if you thought the money banks lend out comes from deposits that people make, you are wrong. Every time a loan is made, the bank creates new money from nothingness. Do you think this is complicated for the bank? Well, it's not. This new money is created with a click of a button and destroyed the same way when the debt is paid back. Sounds unbelievable, but it's all true. Let's expand on our earlier example. You deposit $100 into bank. Under the fractional reserve system, with a 10% reserve requirement, the bank keeps $10 and lends out $90. This $90 is not existing money, but newly created digital currency. It appears in the borrower's account, effectively increasing the money supply. Now, when this $90 is repaid to the bank, along with interest, something remarkable happens. The $90 part of the loan, the principal, is erased from existence. The money supply contracts by that amount. The interest, however, is where the bank makes its profit. Now, pay attention here because it's really important. The interest paid on the loan remains within the economy. If you ask, what's the big deal? Who cares? Here's the answer. This touches everyone's lives and pushes the price of practically everything higher. You see, when banks create more money this way, the amount of money in circulation increases. This is a topic for another video, but I'll touch the surface here. In the past 4 decades, the act of money creation by banks has swelled the amount of circulating money by an average of over 11% a year. This relentless tide of new money flowing year after year has done more than just swell bank balances. It's been a silent force behind the soaring prices, and one brutal example is housing. Today, the dream of home ownership is nearly out of reach for most people, and it gets worse. If the current level of money creation by banks continues, the future generations cannot even afford to dream of buying their own house. Banks have played a big part in driving up house prices. They've made it easier to get mortgages because of lower interest rates and less strict rules. This means more people can borrow more money to buy houses, which pushes up house prices. Government efforts to help more people buy homes have actually made it harder, as these policies have led to higher prices, pricing out young people, lower income groups, and minorities. As a result, these groups often can't afford to buy homes and are stuck renting. This all is a cycle of creation and destruction, where banks are at the center, creating money through lending and then collecting interest on those loans. This mechanism highlights the bank's role in the economy. They don't just hold money, they dynamically control its very existence. Most of our money is, in essence, a byproduct of debt, a series of digital entries that come and go, shaping the economy's heartbeat. In summary, money in our modern economy is largely an abstract concept, created and destroyed through the processes of lending and repayment, with banks reaping profits through the interest collected on these loans. I have mentioned loans and debt many times throughout this video, and I've done this on purpose. I wanted you to realize the mind-blowing fact that debt is money. Without debt, money cannot exist, or at least it is a fact in our modern economy where banks are in control. Thank you for watching. If you've been astounded by the secret journey of your bank deposits and how banks transform them into profits, don't forget to express your thoughts. Hit the like button to show your support, drop a comment to share your views, and subscribe for more eye-opening insights. Your engagement helps unravel more mysteries of the financial world. Until next time.